Now that we have calculated activity ratios, especially the cash conversion cycle, we will look at the other activity ratios which are related to the turnovers. The first one we'll look at is the working capital turnover. So how is working capital turnover defined? This is the annual sales or the annual revenues divided by your average working capital. So let's find the average working capital first. Working capital is defined as current assets minus current liabilities. So what is your current assets in 2006? So working capital for 2006, current assets here is 250 and current liabilities is 150. So working capital will be 250 minus 150 here. This comes out to be 100. So let us find out the working capital for 2007 now. 2007 working capital, we must first note what is the current assets of 2007, that is 370, and the current liability is 150. So 370 minus 150, so this comes out to be again 220. So your average working capital will be 100 plus 220 divided by 2. So your average working capital 100 plus 220 divided by 2. So this is essentially 320 by 2. This is 160. Let's calculate the working capital turnovers. So working capital turnovers as defined as sales divided by average working capital. Sales is 400 here and the average working capital is 160. So this comes out to be 2.5. Now let us move forward and calculate the other asset based turnovers. So the first one that we'll look at is the total asset turnover. So we have earlier looked at total asset turnover. This is defined as your sales divided by your average total assets. So sales divided by your average total assets. What is your total assets? Your total assets is 830 and 1000. So your average total assets here will be 830 and 1000 here. So we'll add this up and divide this by 2. So this comes out to be 1830 divided by 2, that is 915. What about the sales? Sales was 400. So this is 400 divided by 915 and this comes out to be 0.44. Now note the 0.44. Sales upon total assets is less than 1. So this means that a lot of assets is actually deployed in generating sales, and it is basically a capital intensive business. A lot of assets are basically used up for generating sales here. This is unlike a retail industry where you will have this asset turnover very close to 8 times to 10 times, because they generate a high volume but low margin sales, so but yet make it a kind of a profitable situation for themselves. So it's different from retail. Now let's look at the follow-up of the total asset turnover. We call that as the fixed asset turnover. So fixed asset turnovers is defined as sales divided by your average net fixed assets. So your sales is 400, but let's look at what is the net property, plant and equipment or net fixed assets. This is 580 and 630. So 580 plus 630 divided by 2. So here in this case it will be 580 and 630. So we need to add this up and divide this by 2. So this comes out to be 1210 divided by 2. So this comes out to be 605. So this number comes out to be 605. Sales is 400 divided by 605. This is equal to 0.66. So we have calculated almost every activity turnovers here. Fixed asset turnovers, we have calculated total assets turnovers, and we have also calculated at the top working capital turnovers. So let us now move forward and look at the liquidity ratios.